after COVID hit, suddenly the US come out and say, we're going to print money, we're going to do everything, we're going to run to the rescue of the corporate bond market. They injected loads of liquidity and the markets went and exploded upwards. Everyone said, oh, this is terrible, it's going to be terrible, COVID's going to be awful, I'm not getting involved. And they missed out on 60, 70%.
We have 10% of the portfolio in the FTSE 100, which, as you saw, has done very well.
Bulletproof.
Let's hope that's not the top of the market.
That is the kiss of death, yeah.
Oh dear, I'm sorry, but that's the first one for a while.
So the big question to me is, why, with such a positive environment for risk and such a positive environment for liquidity, driving those equity markets up and driving earnings and all these things, why is the bond market not saying, don't like this?
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to IG's award-winning podcast, The Art of Investing, with me, Rich McDonald, here to bring you the latest insights into the investing world and education on how to best look after your money. To help me with this, each week I've got my industry experts. It is Bond Supremo, Chris CJ Fellingham.
Hello, Richard.
Well, hello, sir. And my equities expert, it's Spice, Mark Holden.
Hi, Rich.
How we doing, gents? Have we had a good week?
We've had a very interesting week. It's been, this is my sort of depressing time of the year because it's the Six Nations and being a loyal Welshman, I travel down to the Millennium Stadium, or the Principality Stadium as it's known now, and watch us lose. And so the highlights I say to all my friends when I go down there is watching the fireworks beforehand, because the rugby isn't much to write home about. So last week, I was watching them against Wales. Mark was there as well. Spicy was there as well. And this weekend, it's the podcast going down there. Rich, me and Spice and a few others to watch against the Scots. It's going to be an interesting game, but unfortunately, I think another poor match for the Welsh. So I've got that. I'm also, for my sins, I mean, you're going to say that I'm really attracting the bad news. I'm a Tottenham fan as well. So we've got Arsenal-Tottenham this weekend as well. So that's another loss. So there's not much to look forward to.
Is that Saturday as well?
That's going to be, I suspect it's the Sunday game, but to be honest, I don't want to know because I know what's going to happen. I did want to correct something, though, that we said last week. I was called out by an ex-senior executive at Gartmore, a very good colleague of mine. And he basically said to me, love the podcast, but you talked about the golden era of fund management in the City of London. And you talked about Mercury, Phillips & Drew Fund Management, Schroders and Morgan Grenfell as being the big team in the 90s. And he reminded me that Morgan Grenfell weren't that time in the early 90s. It was actually Gartmore. He said to me that, he wanted me to make sure that was right because of his tradition there. And also he's a very important man in the city, sir. So I need to be very polite to him.
Well,
so I've done my piece there. And what I would say is it was Mercury, PDFM, Schroders and Gartmore. But then Gartmore and PDFM lost that mantle
to Morgan Grenfell.
Please stop saying the word Gartmore because it sends shivers down my spine, even 22 years later. Because my very first week on the desk as a market maker at Credit Suisse, it was, I think, Thursday afternoon. My boss went to the bathroom, so I was left looking after the book. And the sales trader jumped up. Rich, where can I sell 250,000 Morrisons for Gartmore? I said, my very first bargain on risk. On the touch. No problem, Farkey.
What does on the touch mean, please?
On the touch means that they could sell 250,000 Morrisons, so about $5 million of stock at the current price without a problem. But I'm not selling it in the market. I'm taking it onto my book, so then it's my position. 7 minutes later, profit warning for Morrisons hits the tape.
Oh.
On a Thursday afternoon, like 4 p.m., we're down, $300,000 immediately.
And it's your first ever trade on the
First
desk.
ever bargain. So
do you think they knew something, Rich? Do you think they knew something?
That would never happen.
It would never happen. Would
Never.
it? Never. Insider dealing and all that sort of thing never used to go on.
It's very lucky.
Yeah.
Not for me. How are you, Spice? Good week?
I'm good. I've been consoling Welsh people, including CJ from the rugby, and consoling myself after losing to Scotland. Well done, Scotland. I'll sort of eat humble pie. But note, this week I'll be supporting Wales against Scotland.
Oh dear.
Other than that, I've been trying to work out how to join the British Winter Olympic team. So I've strapped the odd tray to my chest and throw myself down the odd hill. But apparently I'm not good enough at qualifying time.
Well,
so hey ho.
That's normally after lunch, that is.
Yeah.
I thought I actually saw both of you on the luge doubles when one goes down on top of the other 90 miles an hour down the track with no brakes. It sounded like some of your risk management.
Well, you wouldn't want to see us in Lycra, that's for sure.
And Rich, while we're talking about sort of last week, I can't help but notice that you've got something up with your wrist.
Yes, that was a tricky moment on Sunday, actually, after watching the snowboard cross and the ski jumping. And I got especially inspired, thanks to my friends at Team GB, actually, sending me the stash.
That's nice.
I've got a hat for you as well.
Oh, lovely. Looking forward to that.
Yeah, so I was excited by the gold medal, went to the top of the stairs and was shouting to my mother and started to do some kind of ski jump routine on top of the stairs, which didn't go well because my arm gave way. I fell flat onto the top stair, cracking my rib, which is especially painful at some points, and then proceeded to fall down the stairs and land on my wrist. So I've also fractured my thumb, which is great.
It's quite difficult when you hurt your ribs, isn't it? Because if you have to laugh, it's a problem, which is a good job you're with us because you never have to laugh. So
I don't think I'll be in trouble.
Oh, there we go. Got him. Absolutely brilliant. Anyway.
Shall we move on?
Yeah. Let's move on.
So what about a spice market update?
Well, first of all, I want to say Happy New Year, Lunar New Year to our friends in Asia.
The year of the horse.
Indeed. Well, this year, it's been a pretty uneventful week, and most of the Chinese markets and Asian markets are closed for this week, the Lunar New Year. The Americans took the day off on Monday. Trump had his own day, the President's Day. So it's been a relatively quiet week. But there's been some things to celebrate. The FTSE 100 hit an all-time high again.
Hey!
And most of the European indices had a good week as well, actually. So the Stoxx 50 and the Stoxx 600, which we started a position in last week, also took out their all-time highs, which is good news. That was driven in the UK partly by the fact that UK inflation data came out, what's called the Consumer Price Index, the CPI, came in lower than expected. It came in at about 3%, and it was expected to be about 3.4%. So that was really good. And it meant that the potential for interest rate cuts in the UK, the chance of that increased quite markedly. The next meeting is in March. And before the data came out, we were looking for about a 50% chance of another 0.25% cut. And that rose to about 90%. So, if you've got a mortgage, keep your fingers crossed. Hopefully the rates will be coming down in the near future. In other equity news, we're at the tail end of the reporting season. As you know, the last few weeks, we've been inundated with 20-25% of the S&P reporting week in, week out. And the only thing we've got really to look forward to next week is NVIDIA, the world's biggest company. So they report on Wednesday next week on the 25th.
Just in time for our recording the pod after.
Exactly. So we're hoping they'll be good. And actually, NVIDIA's had not a bad week because they announced that Meta are going to use all of NVIDIA's chips for their AI projects. So that pushed NVIDIA up a bit on the week, which helped some of the other equity indices, particularly American NVIDIA as well. Outside of tech, there's been some disappointment in businesses that are exposed to the lower end consumer. People are struggling. We've talked about this K-shaped economy before. The rich are doing very well. The poor are struggling. And so Carrefour in France basically had results and they were disappointing. The shares fell about 5%. Carrefour, they're a big French supermarket.
The
retailers.
Tesco of France.
Okay.
Mais oui.
He was like that all weekend.
Yeah,
and Wales, France, he was, mais oui.
Mais oui, allez le bleu.
Oh, no.
But elsewhere, the FTSE also got some good news because Glencore, if you remember, there was some disappointment that a couple of weeks ago they called off the bid the merger with Rio Tinto to the FTSE's bigger companies. And Glencore had their results today, and they've been holding back some cash for just this moment. The shares are up 3%, and they've decided to give $2 billion back to shareholders in the form of a share buyback. If you remember, this shrinks the amount of equity in there. Another way of giving money back to shareholders, which is taken positively. I say the shares up 3%, and it helped the FTSE. We'd noted in the last couple of weeks the big sell-off we've seen in software companies and software shares around the world. And it's one of the reasons that we reduced our positions in America, particularly NASDAQ. We're now out of NASDAQ. And that sort of sell-off continued a bit. Not to the same degree as it's done in recent weeks, but down about another 5 or 6%. And they're now down 20% year to date, that sector, which is huge. It's been taken about $3 trillion off the market capitalization of these software companies.
The good news of the story is it did give us our very first viral TikTok. Now, I know you don't even know what TikTok is, CJ. But
I don't.
But
What's
you're
the
now TikTok. Oh dear, I'm sorry, but that was the first one for a while. You had a warning on the Alley Le Bleu, but yes. So if you want to subscribe to our TikTok, it is _the art of investing. If you're on TikTok there, we'll start a Reddit and a Instagram and everything soon, I'm sure. But this was our first trial, and it was particularly of interest to people selling our NASDAQ position. That's why it went viral, because in the comments, you had a real argument going on, 50-50, whether people agreed with it or were against it.
Yeah, let's say it's been a massive sell-off. And actually, arguably, you could say that maybe the baby's been thrown out with the bathwater, because there's been a huge derating of these companies. If you go back to October towards the peak, these companies were trading on 30, 35, 40 times forward price earnings ratio. We've talked about the way valuing these companies with the sort of the value of their earnings per share. And it was trading, like I said, about 35 times the sector. Now it's down to about 24. So it's pretty much just a small premium to the S&P 500, which trades on about 22 times. And it's delivering probably some of the biggest upgrades in the market. So the actual businesses they're running today are doing very well. People are worried about the future, and to the point where people now, every time a company says they're going to increase their capital expenditure in AI or data centers or whatever, the shares have been hurt. But actually, I've noticed there has been some change of sort of rhetoric coming out, and companies are now being more cautionary about sort of talking about the capex in that way. They're now saying, well, we're going to spend all this capex, but we've already got takers for 80% of the capacity. And that's being taken positively. So if you can prove you're putting this capacity in, but you're already forward selling it to other people, not just yourself, then that's being taken positively. So just keep an eye out in statements for total consumption or capacity usage. Those are the sort of things that people look at, or the receipts they're getting from this AI spend. But a marked change this week in perhaps the rhetoric.
And it shows you people aren't stupid. It shows you that the chief executive and the finance director have been told by their investment bank, don't, whatever you do, emphasize how much money you're putting in. You've got to emphasize this. And now everybody changes their tune in an attempt to keep their share price going. It just shows you how this all works. I still think it's, and we'll talk about later about using AI. I still think that there's no way at the moment of being able to forecast who in this software area are going to be the winners and who are going to be the losers. And, if it's still on a premium, maybe it's got to come back more.
Well, yeah, people are in the shoot first, ask questions later mode. Yeah. But, when you start seeing this stuff spread across all the newspapers and all the news wires, maybe it's getting in the price. That's a lesson we've talked about with Bitcoin and so on. And so you just got to be cognizant of that. Interestingly, talking of things that are sort of backward looking, we had the Bank of America Fund Managers Survey out yesterday. And actually, this is something that a lot of people look at of interest. It shows you what fund managers have been doing over the last month or so. And the sentiment is very, very positive, as you would expect, because markets, most of them outside of the US, are actually towards their all-time highs. And actually, the US ones aren't far off their all-time highs, despite some of this rotation that we've seen from the technology and the software companies. So they're very positive on global growth and earnings per share coming out. So there's no sort of hard landing expected from sort of the last couple of years. And so, yeah, they're starting to expect an acceleration of growth, not just in the US, which I've talked about a lot before, but it is beginning to happen in other countries because, and we'll talk about this later, governments in places like Japan, in Germany, and the US are all spending more money trying to get their economies going through fiscal spending, it's called, by either cutting taxes or just sort of pumping money into the economy. So positioning, most of the institutional or the professional fund managers are very overweight in equities and in commodities. No surprise really, as gold and silver hit all-time highs not that long ago, and copper's hit all-time highs so far this year. And they're most underweight in bonds, government bonds. And it's an area we don't particularly like. We've only got about 10% of our portfolio in that. And they're very low on cash. So they're heavily invested in what we call risk assets, which is pretty aligned with what we think. Do we have to worry that, we're all similarly aligned? I don't think so, because, the thing that they're excited about is this extra government spending on top of the capital expenditure that's coming through AI, which is adding, it's beginning to spread out into other parts of the economy.
It's only if we started to see inflation come through the system, that would be the concern, because then higher rates with all this debt-funded spending they're doing, that would be the end of the road, wouldn't it?
Absolutely, yeah. And I say it helped this week, the fact that the UK inflation data was actually much better than expected. And the UK is notorious for being poor at getting inflation down. So, like I say, that's helped this interest rate outlook for the UK. And it helped other bond markets. Actually, bond markets have had a pretty good week, which maybe we'll come on and talk to about in a minute. But outside of that, I just wanted to mention something that happens in America at this time of year, and actually about every 3 months. And they're called 13F disclosures. So this is where big institutions, big investors, show the market what their big position changes have been. So people like George Soros has been, who Chris used to work for, has basically announced this week that he's been buying healthcare stocks. And actually that suits us, because we've been buying the European indices. There are a lot of healthcare stocks in there. So that's been good. Maybe he's buying the Stoxx 600. You never know. I think this healthcare is the first or second biggest sector in that area. So Soros has been doing that. Nvidia, as its company had to disclose, they buy lots of stakes in lots of companies. They disclosed that they sold the last of their stake in Arm. Remember Arm, that Cambridge company of ours that sold to the Japanese? Then Nvidia 5 years ago tried to buy Arm, if you remember, and they failed to do it because the regulators wouldn't do it. They thought they'd have too much of a monopoly in that. But they sold the last of their stake in Arm over the last few months. This shows what they've been doing the last 3 months. In the UK, you don't have to disclose that. You only disclose when you change a percentage. So until you've got 3% of a company, you don't have to announce it. Once you go over 3%, you have to announce that you've got 3.1% or 3.01%. When you go to 4, you have to disclose. When you go to 5, 6, 7, all coming down as well. So the UK, we do it in a very timely manner. Within 2 days of you doing that, you have to report it to the stock exchange, and that information is public knowledge. In America, they only do it once a quarter. And through these 13F disclosures, which we had a lot of this week.
And Buffett sold 75% of his Amazon.
He did. And he bought New York Times with it as well. But I mean, look, to be fair,
he's following our strategy. Out with the new economy, in with the old.
Yeah.
Well, the trouble is he's more bearish than even you are, Rich. He's got, he runs about 600 billion, I think, and about half of that is in cash. Only half of it's invested in quoted vehicles. Anyways, but he's called the Sage of Omaha for a reason. He's a very, very wise man, but he's a value investor, and he has been turning more to this, as we have been doing, into the industrial and value parts of the market. Other things, really, I just wanted to touch on the US-Iran talks over the nuclear deal has become a bit fretful in the last few days. And I wanted to point out that the oil price has been going up as a result, because once again, J.D. Vance, the vice president in America, threatened military force if they don't come to the table and do a deal. Yesterday, the oil price is up 4% of that as a result. And the oil price is up 14% so far this year in 2026, which is a big move for oil. So you've got to keep an eye on that, because if it comes too out of control, people begin to worry about inflation coming through, etc. And it's a cost to business, obviously.
It's funny, it's one we've never had a position in.
Well, we talked about it a few times. I think we talked about it about 3-4 months ago, and we were right not to get involved. We thought about it, but we thought, no, there's better money elsewhere. It's then slipped back down again, but it's bouncing along that bottom level. It's a question of whether it's going to break out or not, and I think we can reserve the judgment for the moment.
Yeah.
There doesn't seem to be any real impetus there, but let's keep it on the ledger to look at.
Yeah.
I think it's also benefited from the fact there's some money come out of things like silver, which we know has had a big sell-off. from its highs, having sort of been absolutely rampant earlier in the year. It's come back sort of 30, 40% from those highs. And money rotates within the commodity sector from one to the other. And same thing probably from gold as well.
Worth shouting out, actually, we're going to speak about silver later because we've had a question come in from a viewer, and we are going to answer a good number of viewer questions in the latter part of the podcast today. But before that, CJ, anything that's caught your eye?
I got three things, really. Crypto. We've talked about crypto being a bit of a disaster area. And I noticed it on Friday, the Brevan Howard Digital Asset Fund announced it had fallen 30% in 2025, which is worse than Bitcoin. Bitcoin didn't fall that much. That's because it's invested in lots of other things apart from Bitcoin. The thing I found most interesting was it on the front page of the FT. Remember what I've said before, when it only appears on the front page of the FT, often telling you that actually the bad news is in there. I don't remember when this same fund was up 43% last year and up the year before last and 52% the year before that, it ever being on the front page. So just helps me think that we're getting towards the lower end of the range for crypto. Secondly, Mark talked about the Merrill Lynch survey. One of the things that was very important in there is what he said on the dollar. Now, you'll know my view. I'm not very positive on the dollar. I think the dollar should weaken off. But you should be mindful that in that document, it says that the investors have their highest overweight position to the euro since 2004. And that's the mirror position of the dollar. So they're long euro, short dollar, highest since 2004. And it's the biggest underweight seen to the US dollar overall since 2012. So what it does tell you is the market is feeling very much the same way as I feel. So therefore, you're not going to get any gratification from that view, I think, in the short term. In the short term, I think there's so many people who've got the same view, it's unlikely to move very much in your direction. So that was my second point. My third point was, finally, for those nerds like me who are bitter and twisted about how the City of London has lost its way over the last few years. Let me explain what I mean by that. There's a chap who I call the Lord of LDI. Now, when I say LDI, I mean liability-driven investment.
Oh, do tell us.
And liability-driven investment was really carried out by defined benefit pension plans, which is what everybody used to have in this country. So where the sponsoring company would guarantee what you were going to get as your pension. So that's what a defined benefit pension plan is. So liability-driven investment is when those defined benefit pension plans realized that their liabilities were moving very closely with bond markets because they were priced off the yield in bond markets. So when bond yields moved higher, the liabilities went lower. And when bond yields went lower, the liabilities went higher. And therefore, if you took a position in bonds, it moved in line. And so there was a big move in the early 2000s by a number of people, but John Ralph, the Lord of LDI, as I'm talking here, was one of those people telling people, you need to sell your equities, you need to get out of risk assets, you need to match your liabilities with fixed income and bonds. Now, that was a sensible, logical thing to do for your liabilities, but what it took away was that huge weighting that our pension funds had in equities.
Right.
In this country, 70 to 80% of the pension fund was held in equities, predominantly in the UK. You might have half it in the UK. And we then reduced all our equity weightings in these big pension funds down to sort of 25%, of which a fraction is in the UK. So we went from an equity-owning institutional framework to being very little equity.
So if I understand that, it was a lot of money going from Spice to you.
Yes, which is why I am
he became a
more
boss.
successful than Spice has been. Spice, don't hit me.
Very true, very true.
So now, as we know
right,
from this podcast
absolutely.
and from all the evidence, although it may have matched their liabilities well, it cut them off from the great return of equities over bonds and cash over the long term. So this article was written about the Church of England pension fund, which was in a dire way and was told, you need to go to an LDI way of doing things in the early 2000s, because if you don't do that, you're going to have all sorts of problems.
Right.
They ignored that advice.
What did they?
And they held 72% in risk assets up until where we are today. So, of course, this wonderful performance in equities over time has transformed their pension fund from being massively underfunded to being massively overfunded, and they're now returning to their pensioners the benefits they previously had lost because the pension fund's in such a great state.
Praise the Lord.
And the Lord of LDI is now telling them, now is the time to move from equities and risk assets back into bonds. So having, I'm not going to say heeded, but having a number of people tell you should have done it a long time ago, lost a load of money from having done that in terms of your exposure to equities, although your pension fund was moving in the right way with regard to your assets. The people who didn't do that trade have made so much more money. And my whole argument here is, if we hadn't have done all this LDI, if we had kept our equities in our pensions, there would be a huge amount more wealth created for the institutional network than we have actually managed to do.
And that's one of the messages that we put forward in the podcast right from episode 1.
Episode 1, if you look at any long-term track record of the performance of assets in real terms, equities outperform over bonds, over cash. And so what we've said all the way along the line, you can see it from our portfolio, we keep cash and bonds as low as possible, and we have lots of exposure to equity while that makes sense, while we think that makes sense, because of the returns we can get. We've seen that in our numbers for our portfolio that we're running now, and we can see how things benefit when you invest with a long-term outlook, keeping your money towards the equity market. So I just thought it was very interesting to see somebody coming out and saying, I never told you that before, do it now, when in fact they were being told all the time to do that.
Before we continue, I just want to let you know about a limited time offer from IG. Right now, if you transfer your ISA to IG before the 5th of April, you can get up to £3,000 in cash. That's right, you'll earn 1% cash back on transfers up to £300,000. This is a great opportunity if you've been thinking about consolidating your investments and making the most of this great bonus. To take advantage, just use the promo code ISA Podcast. That's ISA Podcast, all in block capitals when you transfer in. This offer is available until April the 5th and is for new share dealing customers only. For full terms and conditions and to get started, head to IG.com. Well, it seems a very opportune time to have a look at the numbers this week in our equity-heavy portfolio. Spice, how's it done?
Been a pretty solid week, I think. We're up about 0.5% week on week. That leaves us now, since we started running the portfolio, up over 17%, 17.3%. And so far this year, we're up about 4.7%. So a good, solid start to the year. Remember, we're trying to do 10% a year, so that's very acceptable. We did a lot of changes over the last few weeks. The main performers actually have been pretty much European equities. So the FTSE 100 is our best performer. It's up 2.4%. We know he's always have a cheer there. But we did put some money in the Stoxx 600 ETF last week. That's the one that includes a bit of UK as well as the broad Eurozone equities. And that was up 2%. So there was a positive sort of bias towards European stock markets. And in fact, the third best performer was the German DAX, which got caught up in money flowing potentially from America probably into the European indices.
So the things we've been buying recently have gone up the most.
Fingers crossed, absolutely.
What's down towards the other end, Mark?
The worst performer this week was our favourite, VanEck Crypto and
we
blockchain.
did add to that last week. So what happened there, Spice, do you think?
Well, Bitcoin was up 1%. I mean, I'm saying it's our worst performer. It's down 0.5%.
All right,
so 0.5%. So it's not, we're used to this being up or down 10% on a weekly basis. So 0.5% down is quite a result, frankly. With Bitcoin was up 1% week on week. That's sort of pretty much in line, shows you they're probably maybe a bit in sync. And we've talked a little bit earlier about feeling that maybe the sell-off in those cryptos and Bitcoin may be coming towards the bottom. Fingers crossed there. But other markets that performed a bit more poorly was Japan's Nikkei 225, which we took some profit on last week. We've sold a quarter of our position, so 2.5%, and that was flat on the week. Remember, we sold that because we wanted to take a bit of profit after a very good run. The week before it was up sort of 8-9%, I think it was. We talked about the adage of better to travel than arrive. We had the big election in Japan. Sane Takaichi basically got a massive landslide victory. The Nikkei went up a lot on anticipation of her being able to pump more money into the economy, and the Nikkei hit a high. We took some money out. So we've still got 3/4 of our position, so 7.5% in there, but we had 10, and we moved that 2.5% elsewhere.
Maybe a good moment just to remind everybody who the heavyweights of the portfolio are, because for those that listen on Apple, they won't actually be able to see the portfolio listing. Reminder, you can click into the show notes, and if you click on there, it'll come up on your browser. But what in particular have we got heavyweights in?
So our biggest positions right here, right now, we have 10% of the portfolio in the FTSE 100, which, as you saw, has done very well.
Bulletproof.
There we go. Oh, well, that's
now,
not the top of the market. Shall we sell it?
Yeah.
And the only other position of that size outside of cash and bonds, which are, they don't have much volatility and they're relatively slow performers, if you like, is we've got emerging markets now. We've got 10% in emerging markets, which we've been building steadily. We started 0.5%, then we put another 2.5% in. We had a conversation with JP Smith, if you remember. John Paul came in, and we've added to it again last week. So that's now our equal biggest position along with the FTSE 100. And interestingly, the FTSE 100 has quite a big exposure to things like Asian stocks, because you've got things like HSBC, which is the second biggest stock in the market, and Prudential. We've got loads in the UK, because we used to have Hong Kong as a colony. There's a lot of business, and British companies have a big exposure to Asia. So we've we've got a really good exposure now to things in Asia. So fingers crossed those economies keep recovering, which we're starting to see that gathering some momentum now. The next biggest then is actually our crypto. We've got 7.5% in there, mainly because we've been adding to it because we think that's coming to a bottom, hopefully. And Chris being the expert on that one.
No pressure there. If it goes wrong, it's your fault.
There you go, Mr. Chairman.
You see that? Having tried to sell it up 50% and being told by somebody not a long way away from me,
well, you profit.
You can only sell half. You've got to keep half. Yeah. It's now my fault. We've got it.
Mr. Expert, Chairman.
Yeah, okay. Noted.
Yeah. So the only other thing is 7.5. We've got the Russell 2000, which, if you remember, that's the mid and smaller size companies in America, and we're doing that because we see that as the growth in the economy in the US starts to pick up, and the one big beautiful bill starts to come through, tax cuts, etc., that should benefit mid and smaller size companies. It's up about 8% in 2026 so far, and that compares with the S&P 500, which is basically flat, and NASDAQ, which is down 2 and a bit percent. So the thesis of why we did that is coming through. I am cognizant that, there's been quite a big derating, as we talked earlier on, with these software companies and technology companies. So this sell-off in American sort of indices, I don't think will last too long, but they may struggle to keep up with some of the other markets, which we see us getting the flows into Europe, for example, and into Asia, which is where we're positioned for.
CJ, how would you describe our positioning compared with something like the All World Index? We are essentially underweight the NASDAQ, the S&P 500.
We're considerably underweight the main indices exposure to the US. And I think that's one of the things we've tried to draw out before. If you have exposure in your portfolio, your wealth manager maybe has chosen the world index, you've got 70% of that exposure is the dollar and is US equities. And therefore, it's been really good over the last few years because they've done very well. But the capacity for them to do pretty badly going forward is there. I'm not saying it will happen, but it's there. Now, my personal view is I think we will see underperformance from the US, which is why we have been moving our holdings more and more into Europe, into EM, Japan, all these other areas. And so we have now got quite a big underweight compared to the US. And if we look at the share price performance, that's actually working pretty well for us, because what's happening, as Mark's said, and I've got some numbers here, we've seen a situation where the US equity market has generally pulled back marginally from the highs, But the other markets have gone through those highs. I mean, if I just add a little bit of colour to that, I've just ranted about pension funds selling all their equities for bonds, and I'm a bond man, so you wouldn't expect me to say that. But I think it's been terrible for this country. But let's just look at the returns so far this year. S&P is broadly flat. NASDAQ is down 2. So if you've been invested in world fund, 70% of your portfolio's done small negative, probably. Yeah. Russell's done 6.6. This is to my numbers from when I did it. I'm not disagreeing with Mark's. It depends what time you took it. FTSE 7.5.
Wow.
FTSE 250 5.6. Japan 13.5. Europe 6. EM 7. This is all this year. Remember, just this year from January 1.
7 weeks.
And then US 7 to 10 year, just to give you a bond comparison, has done 0.5%. And the UK FTA All Stoxx, so that's all the bonds in the UK combined together into an index, that's done 1%. So if you're sitting there looking at what your wealth manager is recommending to you, you're probably going to have a load of bonds. Well, they've averaged out at about 0.5%, maybe 0.75%. You've got a loads of US equities, which have averaged out, and I'm being generous, at nothing, 0. And all the other benefit has come from the other things. And that's what we're trying to do in this portfolio. We're trying to help people, showing them how we would make those decisions, trying to help them that their financial journey so they feel more confident about taking responsibility for their own journey. And rather than investing with people who perhaps are playing it much safer, trying to explain that equities over the long term are such good investments. Start to do some of this yourself. Follow this show. This is what we're trying to do here. And that's worked well. We're an eighth of the way through the year. Mark's just said we're up about 5% year to date. We only want to do 10%. We would not normally have expected things to have gone as well as this over this short period. And I think we need to put a marker down. This is been a very good period, but actually, we would not normally expect this much return in one go. When I look at FTSE 100, 7.5%, most people would have said for the year they would expect 6 to 8. So we need to be mindful that we've had a great start to the year. Why is this carrying on? What's going on? And I've discussed in this podcast with you guys. I've been insulted on this. That my view, and Mark will know because I've expressed this to you on many, many occasions. The real determinant of asset prices is liquidity. Everyone will tell me this is trading cheaply or expensively, the earnings are this and whatever. It's, in my view, not rubbish, but it's second order effect. The biggest effect is where is the liquidity, how much liquidity you've got. One perfect example of that was COVID. After COVID hit, suddenly the US come out and say, we're going to print money, we're going to do everything, we're going to run to the rescue of the corporate bond market. They injected loads of liquidity and the markets went and exploded upwards. Everyone said, oh, this is terrible, it's going to be terrible, COVID's going to be awful, I'm not getting involved. And they missed out on 60, 70% up, right? So we've got to think about what and where is liquidity. The markets are telling me there's too much liquidity. And they're looking forward and they're seeing the Fed looking like they're going to cut rates, the UK looking like it's going to cut rates. Even Europe might cut rates a little bit, nothing much. Japan tightening a little bit, but slowly, with fiscal spending going on at the same time. This is a great combination for asset prices.
Yeah,
it's Goldilocks.
Now, we do need to understand that nothing we're saying is new. So we're going through a discounting mechanism. At some stages, it's all going to be in the price. So the real question is, when is this going to be in the price? I go back to what I said before on many occasions. It's a question I'm going to ask you two guys. I'm the bond expert, clearly. But I always look at the bond market to see where there's a problem. And bonds are behaving really well. They're not selling off. I mean, Japan sold off 4 weeks ago and then rallied heavily from those levels. The UK market, even with all the political turbulence we've got in this country, is performing really quite well. And the US 10-year, I mean, it's sitting there nicely. It's not doing any harm. So the big question to me is, why, with such a positive environment for risk and such a positive environment for liquidity, driving those equity markets up and driving earnings and all these things, why is the bond market not saying, don't like this. I don't like this at all. We need to offer higher yields to get people to buy us, so therefore bond prices should fall and yields will therefore rise. So my question to you guys is, why are the bonds being so well behaved?
Well, just a reminder, why would the bond market start to be concerned at that amount of liquidity in the system?
If the markets become more and more exuberant, if they start to really start encouraging people to take risk and start speculating, we normally find that increases demand, increases economic growth, but also increases pressures for interest rates to go up and inflation to go up. Because the bond market looks 3-6 months ahead, as Mark would say, as all investment markets do in fairness, you would expect then the bond market to be saying, there's an inflationary problem coming at some stage here, there's interest rate problems coming at some stage here, and therefore we should be selling off. The second reason is, remember, the governments are borrowing a huge amount of money. They need to encourage people to buy those bonds. If equities look like they're going up forever, everybody's just going to buy equities and nobody's going to want to buy the bonds. So if nobody buys them, yields must go higher, prices must go lower to encourage people to buy them. So all roads point to me to watch the bonds, because if they start going higher in yield, we need to worry. These are the conditions where I would expect to start to see some pressure on the upside. Not happening. So tell me, guys, what am I missing? And why is this, therefore, equity bull market, this risk rally, got more legs in it than we're thinking?
Let's hear the bulls first. Come on.
Okay, so I think there's two big things going on. First of all, three things actually. The inflation data is actually still falling. So as I said, the UK inflation was meant to be 3.4%. It's come out at 3%, much better than expected. That's a reason for people to get less worried about bond yields. So actually the UK bond yields fell this week about 10 basis point or 0.1%. That's despite all the political worries and everything else going on in the background. And actually American 10-year bond yields hit a 12-month low this week. Now, I think that in America is probably more interesting. I think part of it is this money, a massive money coming out of the mega cap stocks, the Magnificent Seven, the technology and software companies. That money, part of it's going into Europe, part of it's going into Japan and the FTSE 100. So that is helping those markets. But some of it is rotating and coming out of the S&P 500 or the NASDAQ and going into perhaps some government bonds there.
Yeah, somewhere to hide.
So somewhere to hide. And I think that, that it shouldn't be ignored, but it is, I think, sort of at the margin, extra money flowing into government bonds. The big thing, though, to me, and I've thought about this a lot, and you've heard me talk about it a lot over the last 6 months, is that the impact of AI on the broader economy is going to be pretty disinflationary. In other words, it's going to make companies more efficient. They're going to have better productivity. They're going to have more profitability, which means that they can also probably cut their prices a bit and compete with their peers by cutting prices a bit because they're more efficient, because they're not having to spend as much on labor. The offset is that you might have higher unemployment because those companies will lay a few people off, use AI to do software writing and programs that they want to do, or analyzing data that they have. That's the most common probably use of it. That will make them more efficient. That will be disinflationary. And I'm a great believer that is probably the biggest driver. You're not seeing it in the short-term yields because those are more driven by what the short-term interest rate expectations are. But the longer-term ones, in 10 years' time, we might be seeing the full benefit or impacts of AI in 10 years' time. So 10-year yields are a thing I watch out very carefully. And, like I say, it was interesting for me that the US 10-year yield hit a 12-month low last week. That, to me, I think says a lot to do with AI and disinflation that could come with that.
I agree with Mark in the respect to AI affecting the long end of the bond market. The short end, I think, is because we're coming up to the anniversary of the tariffs. And we just haven't seen any effects that they really thought would happen to inflation from these huge tariffs. And those were meant to be one-off. So therefore, if it hasn't happened and it was going to be a one-off, then, we are into a sort of disinflationary world with oil almost down as long as we don't get a spike. That is one problem if we get a spike in oil. And when we're looking more at the effects of AI and the disinflationary effects, I think you also have to look at this, go back to this K-shaped economy, right? If a lot of people are going to lose their jobs and unemployment is going to go up to 6% because of the AI effect on jobs, you've already got the middle and working class suffering. It's only really the high income earners that are having this opulent lifestyle. Then you're going to have to cut rates. So you've got a guy, Kevin Warsh, coming in who's going to be under pressure to cut rates. Inflation in the short term isn't going to have any upside effects because of tariffs annualizing. And then you've got unemployment going up, so you're going to have to cut rates. So it is a fairly benign environment for the bond market.
Yeah, so if I take that all together, you can either do it by the way you guys talked about it, or you can reverse engineer it. And you can say, well, if the bond market isn't selling off, and you know all these things are happening, it must be because inflation is going to be well under control and it isn't going to get out of hand. I think what it tells you, therefore, is that the market is moving quickly to an understanding that the theme that we're in is AI is here. AI is going to be disinflationary. If anything, there's going to be economic effects which will be very good for companies' balance sheets, but not awfully good for governments and the politics side of things. And therefore, the pressure will be on to cut interest rates. The pressure will be on to boost fiscal still. And the disinflationary effect will be able to offset those inflationary effects for some time to come. But I think we've got to accept the market is now pricing that in. I say pricing in. Is it pricing all in? It probably isn't pricing all in, but it's getting to that way of thinking. So it's not a new theme anymore. It's now getting priced into the market, which can run for a long time. I still maintain watch those bonds, because if the bonds start to go, you've got a problem. But until then, I think where we are is absolutely where we want to be.
Is there anything that would give you a warning sign? Or is there anything on the horizon, such as oil price spike up to $80? What would make the bond market start to shift?
To me, when you talk about spikes in oil prices, things like that, they're never anything that really affects the market in the long term. It'll affect it for a day or two. Everyone go, oh, look, the oil price is going up. Oh, that's terrible. But then it comes back down again. So the old spike isn't an issue. The issue is if there's a real problem that goes on, let's say in Iran and with the US, and oil goes up and stays up there, then that will be something that will get priced in. But once again, the bond market will show you that. You'll see the bond market yields go up and then say, it's because of this, I'm relaxed about it, or I'm not. But they will still go up. They won't not go up. They will move upwards. And so to me, it's really going to be a question, once again, watch those bonds. We've been consistent all the way since the start of this portfolio. Stay with risk assets. Trust that the equity risk premium, the extra return you're getting from equities is going to pay for itself as long as those bonds behave themselves. And that's what we've got, but we just need to be clear. We're now in that environment where people are starting to price in that really bullish scenario. And it's great to travel. We've made a lot of money, but at some stage it's going to be in the price. And that's what it's going to be about. Whilst we're on the subject, just quickly, of AI, I wanted to try something to show its power and why its capacity for driving efficiency is so enormous. And I was never really into the AI side of things, but I've had some spicy bashing my eardrums for the last 6 months. But I've also got some guys in one of the roles that I enjoy doing who's been talking to me about it for a long time. And I sat down with him, a Swiss friend, this week, and I said to him, look, I've got this issue. Can you help me work it through? He sat down with me and he said, you need to learn how to interrogate the AI. And what that is prompting. So you need to ask the right questions. And what I was trying to do was to work out the volatility of our portfolio. So take the art of investing portfolio and what is the volatility of it.
What would that tell you? What is the volatility measure?
The volatility is showing me the likelihood of sharp moves away from your expected return on the portfolio. So the expected return on the equity would normally be, I don't know, 6 to 8%. We've talked about this before. The vol of it might be 12 or 13. So 8 plus or minus, 13 is a 1.5 standard deviation event. So doing very quick mathematics here, outcome between -5 and 21 should be expected 2/3 of the time. Okay? So you're trying to get an idea of the volatility of the portfolio. The higher the number, the more volatile, the more it's going to move up or down, and the more it's got a chance of selling off or rallying, depending on the market conditions. Now, in the old days, I could only do that by subscribing to a portfolio management tool like Bloomberg. That would cost me 30 grand a year, plus then all the data feeds and everything else. So you're talking substantial sums of money. Or, not many people know this, but I'm pretty good at mathematics. And so I could use my mathematical skills to do it with a spreadsheet. It would probably take me 6 to 7 hours. Anyway, so I said to my friend, let's put this in here. And he showed me how to prompt it, how to ask it the questions. He said, don't use please or thank you. Get aggressive with it. Tell it what you want. And when you don't like the answer, tell it you don't like it. Thank goodness you don't need HR with AI. That's all I will say. I did this. I loaded the portfolio onto a spreadsheet. I put in the codes for the funds. I chucked it in. I interrogated it a few times. When it misbehaved, I told it off. And I got an answer. And that answer came back in 5 minutes.
Wow. 5
minutes. And it showed it to me. I said, can you show me in tabular form? Show me in tabular form. I've got it here on the screen in front of me. It can, if I asked it to show me the coding it had used, it would show me in Python exactly what it's done. It's unbelievable.
I assume 4.5 minutes of that was you typing.
Yeah, with the wrong question or the wrong syntax. And what the answer came out was, our portfolio has a volatility of 13.2% based on 1 year data, daily data for a year, and 12.8 for 3 years. Now that, if we now look at what the S&P 500 is, if we just put all our money in the S&P 500, it would be about 13.5. So the volatility of our portfolio is the same as the volatility of a portfolio 100% invested in the S&P. And that, therefore, is useful for us because what we're basically saying is if we're comfortable with equities, as we've just talked about, we think over the long term they're fine, then the volatility we're running in our portfolio is not excessive.
Before he goes and suggests we buy more of the portfolio, remember that's with 10% cash and 10% in gilts.
That is correct. So I haven't got the figure, but I could ask. I won't do it now because I'll make a fool of myself. But I will ask the AI to actually give me a figure excluding the cash and the bonds. When you've got things like the VanEck crypto fund, which has a 55% yearly vol based on daily numbers, or the BlackRock fund, which has 30%, you can see they're being diluted by the fact we've got the short-dated gilts and cash. But overall, we have the exposure that you would have if you put 100% in S&P. I'm quite relaxed about that. This year has been so far so good, but we need to watch those bonds and play around with AI.
I think the thing that looking at our portfolio the way I do as a sort of equity fund manager, I think the biggest risk to our portfolio, without any doubt, is an economic shock or downturn in economic growth. Because we are now very heavily skewed to cyclicality or what's happening in the real economy, industrial sort of exposure, because we've got the World Mining Trust. Well, commodities go up and down more with economic growth and what's happening in China and in industries. They consume more sort of metals when things are good, and they use less when it's bad. But we also own the DAX, which is a very cyclical index. We own the mid 250 companies in the UK, which is small and mid-sized. They're much more sort of driven by what's happening in the underlying economy. The Russell 2000 in America, 7.5% in that. Emerging markets, very dependent on what's happening to world growth and what's happening in China. And so if the world is growing, led by America, which is what we're anticipating, then our portfolio should do very well. But that's why I say we've got to be very careful. That's the thing I'm watching, because if that growth starts to falter, we need to start shifting that portfolio pretty quickly.
And it'll be interesting to see that. I think we had a question that related to how do you look to break down your portfolio by the various stealth factors. Rich, have you got that one there?
Indeed. Right, let's move on to the viewer questions then. We've got a few to get through. Okay, so this question comes from Joshua Maxey, and he is asking, Do we have any suggestions on ways to monitor specific factors affecting the portfolio, such as FX changes, oil prices, US interest rates? Spice, what do you think?
Yeah, I mean, you can use any AI model and input your portfolio and ask those exact questions. So I did it, and looked at ChatGPT and Perplexity and even Meta AI. The things that consistently come out of it for our portfolio, the top risks are, as I mentioned just now, cyclicality. We've got a lot of cyclicality in there. So we're economically sensitive, and therefore we have to really watch that. Not exposed to US economic cyclicality, apart from our Russell 2000 exposure, which is 7.5% of the fund, but global cyclicality and global economic growth. So we've got to watch that because we've got a big position in emerging markets. So we've got to watch what China say about these things. The other thing that we're also quite exposed to now is small cap or smaller companies, because we have that Russell position. We also have mid 250. So actually, compared to an average fund manager, we've got about 12.5% of the portfolio in small and mid-sized companies. Again, those companies do better when underlying economies are doing better, and they do much worse when they're doing the opposite. And they also suffer when interest rates go up. So we've got to be careful about that. The other area we have to watch is obviously foreign exchange. And we've talked about this before. We've deliberately skewed the portfolio away from the US dollar exposure because Chris's core view is that the dollar is going to go down, and none of us disagree strongly with that. And so if the dollar were to start doing the opposite and rallying, well, that would hurt us in several ways. It would hurt us on translation back in some of our other areas. It would hurt emerging markets. And it would also hurt the FTSE 100 in earnings per share, which is one of our biggest positions, as you know. So we've got to be careful about dollar exposure. And the other question asked it was, what would happen in an oil shock? Maybe oil price went up 25%. I don't think, like we said earlier on, I don't think it would last because Saudi would come to the rescue and start pumping more oil, et cetera, et cetera. But we are actually quite positively positioned, ironically, to a bit of an oil price spike up because the FTSE 100 has about 12% of, I think it is in the FTSE 100 is in oil and energy companies. So that would help our FTSE 100 holding, but it would hurt some of the smaller companies who an oil price rise would hurt them. So it's give and take, but that'd be mildly positive, and other commodities would probably go up with it as well because actually one price is off the other quite often. So I think we're pretty well positioned, but the big thing, as I've talked about before, is this cyclicality, and it's something I'll be watching like a hawk.
All right, so Spice is using AI now. What about in the old days?
In the old days, you would subscribe to a system. Now, there was a firm called, there's still a firm called JP Morgan, but they had a system called Riskmetrics. And you'd basically put your portfolio in there, and they would take it away and using the data that they got, analyze it against all sorts of factors and give you where your exposures were. And that was the only way you could really do it. I mean, you could all clearly look at all the indices separately and what some of their factors are and then work it out longhand. But it's far easier to use the AI to do it. It's just a question of making sure your prompts are correct, having the right questions to ask, but you'll get a very good approximation of where your risks are in your portfolio. And then, of course, the final thing about it is when you get that output, make sure you agree with it. There's no point having a lot of exposure to oil if you think oil's going down. And so one of the things that I think we'll do in one of our forthcoming pods is to look at our portfolio with these factors and just ensure that we're all very clear that we still believe in them. At the moment we do, but as we vary our views, we need to make sure that the portfolio factors vary as well.
Great. Right, on to the next question then, gents, and it comes from Tom Owen. Now, Tom sits in an office where there's a lot of youngsters talking about this silver move, a little bit like they would have spoken around Wall Street bets and the meme stocks, right? Silver is the next, it's going to the moon. So Tom asks, I'm hearing from those younger people about silver being shorted and limited to protect banks from going bankrupt, right? Quite a common conspiracy theory that's been around. They're saying it's another short squeeze, and once the shorts default, it will unravel and up to the moon it goes. Spice, what do you think?
I think you have to be very careful to differentiate between the positions of big investment banks. So if people are buying futures, if the silver price is going up, they often trade in futures or options to get that exposure. And so the bank are effectively going short of silver to those instruments like futures and options. But what that data doesn't tell you is where they're hedging it on the other side. So they know that they've got this extra exposure, and they have lots of risk controls within their businesses that are ultimately scrutinized by the central banks, like the Federal Reserve, like the Bank of England, and they will look at them and say, that is too big a position, you need to hedge it, you need to take some of that position off. Or, let's say, maybe they've got a position in silver, but they'll be hedging it with a position in gold. And the two tend to move in sync, maybe silver more aggressively than others. So maybe if silver moves 4 times the price, 4 times the amount of gold, they need 4 times the amount of gold to hedge 1 silver. And that's the way they would do it. So it's very misleading to look at the pure short data that you see out there. And there's lots of scaremongering on the internet about these investment banks. And there's 22 of them in the world that are short of silver in decent size. But it doesn't tell you that they've got these other hedges or other positions that would offset it. And funny enough, there would have been a lot of profit warnings, when the silver price was going up and doubled again, right? There would have been lots of profit warnings from those banks with that. And the central banks would have been all over them. It's not happened, and therefore we really don't have to worry about it.
If we take JP Morgan, for example, so JP Morgan run the silver ETF. Now, everybody's, of course, been piling into this during December and January. And that exposure means that JP Morgan do have to go into the market and buy silver. Now, people talk about this shortage of physical silver around the world. Well, the ETF demand has led to that deficit in silver. So that has been driving the price up. But as soon as people start to sell the ETF again, then the silver comes back onto the market. This can sound quite complicated when we're talking about physical and futures, and it can be in New York, it can be in London. So let's keep it simple. CJ, something close to your heart, Wimbledon. Right? Now, we could say there's definitely not a shortage of tennis balls in the world, but during Wimbledon week, they need to have the right size of tennis balls. They need to have the right amount of air in them. They have to have those perfect match tennis balls to what they need in the tennis courts at that time during those weeks. And that's kind of what the problem has been. Silver's been in the wrong place. It's not been registered to the exact buyer. And that's just the short-term problem. But you can see when it dropped 33%, that's not any kind of manipulation in the market. That was just an excessive price move coming back to earth.
I love listening to people rationalize things that are irrational. To me, you've got to go look back to 2020 and COVID and the looser monetary conditions, and then what happened with GameStop and the Russell. So you had a combination there of huge retail participation. So US people sitting at home, all in front of their screens, reading their Reddit and their Robinhood, all telling them, oh, you need to buy GameStop because there's these people who are short of it and we can drive them out. The first people who get in, get their positions. They then start pumping it on these social media feeds. Up it goes, up it goes, up it goes, up it goes, and it pops. And the last people in lose their shirt. And everyone else says, well, what's next? Now, if you think about silver, silver is actually quite small market cap. It's much smaller than gold. And once again, it was all over all these social media feeds that there was something going on. Somebody was short of this. Somebody was doing that. Somebody was doing this. Something was doing that. The people who were in there early made a lot of money. Those who bought at $80, $90, $100 have all lost all their money. They also buy it in option form. They don't even buy the spot. They buy call options at 90 or 100, trying to force the market maker, who's taking the other side to that buying, to have to cover it in the underlying, because there's no way he can hedge himself. So he pushes it up as well, and it goes parabolic. Anyone who looked at that silver chart and didn't see parabolic is not living in the real world.
I think one week we will get an options expert in, maybe in the next series, and we'll just discuss, not necessarily for people or not to put them in the portfolio, but just to people have a more idea when they hear about options and calls and puts, what that is. I think that would be an interesting one.
I think that would be very sensible. Yeah. I mean, at some stage, we might actually want to put some in our portfolio because they can change your return profile very much for you in your favor. And if we're going for a 10% return, why can't we sell some of the upside to make sure we get our 10%? So they have a number of good things, but rather than us blab about them now, as you say, we'll get an expert in and they can blab about it.
Right, final question. This comes from Casey. Eagle-eyed Casey, I would call them. This is a great question. Regarding the DAX position shown in the portfolio, because you owned it and then we sold it and then we went back in, it appears to be up 17.5%, even though the position was only re-entered the previous week.
It's been a wonderful performance in that week. If it's done 17.5%, it's got the winning.
The since inception number that we use is the day we first bought it. Even though we bought it, then we sold some, then we bought back into it. But for the since inception number we use, as you say, 17% was from a day back in September, I believe it was, when we first opened a position in the DAX. And so it doesn't truly reflect our performance. Now, our sort of since inception performance takes account of all those pluses and minuses week in, week out. And that number that we see where we're up over 17% so far since inception takes account of the fact that we were in the DAX, we sold out of it, we bought back in, we added to it, etc., etc. So it's a bit misleading. You're absolutely right, Casey. That was a great spot. It's maybe laziness on our part that we haven't sort of been a bit more accurate with that, but it just helps us gauge sort of the movement over that period of time and compare the other assets that we have in the portfolio over a similar time frame. So if you look at the Euro Stoxx 600 since inception, we only put it in on Friday, it's already up 2%. Now, if we analyse that, it's done way better than DAX, but way done better than most things. But that's, our since inception for Euro Stoxx 600 will be as of Friday's close on the 13th, I believe, of February last week.
Excellent. Chairman?
I just think great question, great spots. Our performance numbers you should take as read because they've calculated the whole time with the right numbers. We've been a bit loose in our description of what's going on down the far right-hand side of that table in saying since inception, because as Mark says, we've been in and out of things and it's not properly reflected there. So stick with what have we done since inception in our performance, 17.3%. That is a correct number. 4.7% year to date, and we'll make sure that we mend things so they look a bit better next time.
Excellent. Right, I think that's us for the week, talking about being loose. We'll find out if CJ is going to be loose with his credit cards this Saturday as he takes Spice and I out for a beautiful lunch before we go to that rugby match in Wales.
Winner pays, I'm going to say.
I'm not sure I'm liking the sound of that one. But do give us a shout. If you see us at Cardiff Arms Park in my
Principality Stadium, please. It used to be Cardiff
right?
Arms Park. It's not anymore. It's the Principality Stadium.
What's in the same stadium?
No, because the Cardiff Arms Park is the old stadium before they built the new Millennium Stadium, which is now called the Principality. And if you're still with us, I'm sorry I've put you to sleep.
Good stuff. But yes, give us a shout if you see us at whatever stadium we're at. I'll be in the kilt and the blue and white face paint. Spice?
I shall be wearing red very rarely. I rarely do that, but I will be supporting the Welsh this coming Saturday.
Good stuff. Any questions then please email us in
theartsofinvesting@ig.com.
Good luck. We'll see you next week if we survive the weekend.